Gentlemen,
Evan,
it's quite an anniversary.
it is. It's been.
We've
Go ahead.
celebrating.
No, it's been extraordinary how you could have turned from the complete panic of '09, where the whole question was, will the system survive, and do we need to be in farmland, to a point where this rally has just kept going. We've had scares in Europe, we've had other things, but arguably that's helped because it's kept very low interest rates in the US, it's kept very low yields, it's allowed people to refinance, and can
we go to that chart? Okay, so this is the Dow Jones Industrial Average. The Dow Jones is actually up only 98%, 99% since March 9, 2009. The other indices, the Nasdaq's actually up 135%. Now, when you see a chart like that, you see what happened at the end of 2008 with the collapse of Lehman Brothers, basically collapse globally of any confidence in the markets. Here's my first question, gentlemen. Was the collapse of 2008 and 2009, was that an aberration?
Well, no,
was it simply a blip?
A similar thing happened in 2000. I mean, it was very focused. I mean, this was very focused on financials, obviously took the brunt of it. And last time it was very focused on tech. I mean, if you look at the S&P, for example, between 2000 and 2002, whenever it bottomed, it fell 50% odd. It's not uncommon in the recent history for this to happen. And what's interesting is you've got a very similar shape. People panicked, people completely lost faith, and then it came back pretty quickly, much faster than, and it actually analogously, much faster than jobs came back, much faster than the real economy recovered.
So you're saying, so did the stock market do what it's supposed to do, which is,
as if it was doing it on its own?
No, was it a forward-looking indicator of
the market did what it's meant to do, which is it didn't fight the Fed. The Fed said, we're going to make this happen both times.
Taking the words out of my mouth.
And after the 2000 crash, the Fed basically said, we're going to keep interest rates very low for a long time. We're going to signal very clearly what's going to happen. And the market took note from that and rallied hard, and the economy followed with a big delay. And the same thing appears to be happening now.
The big difference, though, the Fed is the key factor. To me in all of this, it's clearly, you can't possibly think about what's happened since 2008 without looking at the trillions of dollars in liquidity that's been produced, not only by the Fed, but by the ECB, the BOE, the BOJ, big central banks of the world. The other thing to think about, though, if we compare 2000 to now, is the economic recovery this time around, of course, has been considerably slower. And so it has the feel of a much more illusory gain, or a gain that is benefiting a much smaller sliver of the US society than what was happening the last time around.
Hang on, just to add that, I mean,
just to be clear,
there was a jobless recovery last time as well. I mean, it wasn't nearly as extreme as this, of course, but the focus was the same, which is why aren't we producing these jobs? The economy seems to be recovering. We're not producing jobs.
And there were lots.
And then
by the way, they were all fake jobs. They were all, well, not fake, but they were all construction jobs to build houses.
Which are real jobs at the time.
So on that level, maybe this will be, in some ways, a better recovery because the jobs will be export jobs.
We actually have a jobs chart here. Nice little segue. And this basically shows that up until the collapse, this is the unemployment rate. So you see unemployment really just jumped dramatically. There's no time scale on the bottom. But I'm basically thinking that must be around a beginning of 08.
Right.
That unemployment basically went from 6% up to 10%.
A little earlier than that, but nonetheless, what would be very interesting, we look at this chart and then look at the 2001 and then look at previous recessions, and you're probably seeing a flattening in this curve, right? You see, it used to be that we would come out of these recessions with a much bigger pickup in employment, and therefore a bigger drop in unemployment. But I think what we've seen is this process by which it becomes drawn out, and that's the sort of the financial factor rather than the real economic recovery.
I want to get to the point that you raised about the central bank, or the Federal Reserve in the case of the United States, it would be the ECB in Europe. The central banks, you would argue, have facilitated, if not induced, the stock market recovery. I mean, this basically, if you ask Ben, so you say clearly, without the central banks, though, is the case for corporate profits enough to justify the bull market that we've seen in the last 3 years? Meaning, is it illusory? Has the bull market run been illusory, as Michael said, or is it a real bull market?
No, the profits to a large extent are real, clearly. But I think the point with the central banks is they stepped in and stopped the system from collapsing, the deleveraging happening, which would have hammered the real economy. So I think, yes, the Fed itself didn't create Apple's profits. obviously, but it created an environment where that could happen.
The whole point, and you know this better than anybody, Evan, the whole point, the relative value of those Apple profits are now considerably higher when the risk-free return you can make on your money is close to zero, which is precisely what the Fed was trying to do.
Now I'm going to quiz you guys. I'm going to see how smart you guys are. Okay, you didn't know, for example, Thorold, that the Nasdaq was up 135%. Do you know what the 10-year, the rate on the 10-year Treasury was? I'm going to take a guess from each of you. What the rate on the 10-year Treasury was on March 9th, 2009. Michael Casey, take a guess. I know you probably don't know. Take your best guess.
It was pretty close to this. It was 2.4.
Wrong. What's your guess?
I would say it went down to around 2 at the end of 08, and then by this point was up at around 2 points.
Okay,
I'd say 2.5 or 6.
Okay, look, I might be wrong, but I checked quickly before I came on, and I found the 2.89 rate. So it was around 2.8 to 2.9,
right.
which by the way, we are much lower.
Right.
Now, isn't that, if I had asked you...
That might be something to do with the central bank buying all the bonds at the end of the curve.
It could have something to do with that. Now, let's look forward. Michael Casey, both of you guys tend to be somewhat cynical about the stock market. You would call yourselves realistic. Let's look forward. Does the stock market have a lot more room to run?
I just kind of have to say no. I mean, and because as you describe me as a cynic and a realist, perhaps. Either way, I don't see it. And I think that the key point is going to be the Fed. I mean, you hear so many strategists, analysts will say to you, "Don't fight the Fed, don't fight the Fed." At some point, the Fed's going to have to turn the other way, right? Okay. And that is the big risk. Okay. If that being that's the concern, where does it go from here?
Okay, Thorold, final answer. Looking forward.
No, he's right. The question though is going to be, you are seeing improvements in the job market, clearly, and you're seeing that today, a continuation of a trend. If that can continue, there is potential for this to run further.